Here we're going to be looking at the gross profit method of estimating inventory on hand. It's also called the gross margin method here. So where would we use this here? Sometimes taking physical inventory is impractical, or where inventory is destroyed or the records are destroyed, and also auditors use this gross profit method. Now with the gross profit method, you rely on three assumptions here. Number one, the beginning inventory plus purchases equal the total goods to be accounted for. Number two, goods not sold must be on hand here. And number three, sales reduced to cost. You deduct that from the sum of the opening inventory, and then you'd add the purchases. That would equal your ending inventory here. And for our gross profit percentage, that's based on policies or prior period records here. So we're going to look at two methods here, and we'll start here at the gross profit method number one, or this would be the traditional method here. This is where you have your beginning inventory at cost. We have it 120,000 here. Purchases here at cost 400,000. Goods available at cost. You adding those two amounts together, you get 520,000. Now this is where we'd have our sales here at our selling price. We have to know that 560,000 for this example here. And now this is where we would subtract out this gross profit, and the gross profit is based on 30% of sales here. So 30% here of that 560,000 here, 30% of that gives us $168,000 here for our gross profit at 30% of sales. Subtracting that from our sales here of 560,000, so we get our sales here at cost of $392,000. So now subtracting our $392,000 here, our sales at cost, from our goods available here of 520,000 gives us our ending inventory at cost at $128,000. Now this is an estimated amount, remember. Now let's look at gross profit method 2 here, and this is using the income statement format here. So again, we have our sales here at $560,000, and then we have to determine our cost here on our sales here. So in this case, again, our beginning inventory at $120,000 plus purchases here 400,000 gives us our goods available for sale here at $520,000. Same as with the traditional method here for our cost on sales. But now this is where we have to come in here, and we have to work backwards here. So the first thing to determine our gross profit here, our cost of goods sold, and also finally our ending inventory. So we're going to start here with our gross profit on sales. Now remember, that was 30% here in our sales, and we're going to calculate that out here. So we take our sales of $560,000 here times that gross profit on our sales of 30%, and we come up with $168,000. So that's our gross profit on sales here. Number one, gross profit on sales, $168,000. So knowing that here, now we can determine our cost of goods sold. And that's simply looking here at the sales of $560,000, and then you would subtract out your gross profit on sales, $168,000 here. So the balancing amount here would be $392,000, our cost of goods sold. Again, $560,000 here for our sales minus our gross profit on sales $168,000. That gives us our cost of goods sold here of $392,000. Now knowing number one here and number two, we can determine number three here, our ending inventory. So in this case, we know what our goods available here for sale are, 520,000. We can go down there and look at that, 520,000. Now we would subtract out here our cost of goods sold here of 392,000, because we have to come up with this balancing and ending inventory amount here. So we know our cost of goods sold here at $392,000. So here again, our goods available here for sale at 520,000 less our cost of goods sold here of 392,000 gives us $128,000 for our ending inventory here. So you can see that here. We calculated our ending inventory using this gross profit method here based on this income statement format approach here. Our ending inventory here is $128,000. And we've gone through this three-step process here. First, we had to determine our gross profit here on sales, and then knowing that, we could determine our gross profit here sold, just simply the difference between our sales here and our gross profit on sales gives us our cost of goods sold. And then we work backwards here again, knowing our goods available for sale here at 520,000, and then knowing the cost of goods sold here at 392,000. The balancing amount, or the difference between those here, would be our ending inventory here at $128,000. So this is just the two basic methods here that we could use here for determining our gross profit here, method for estimating our ending inventory, or our inventory on hand.